Hello everyone. In this video, we will be evaluating a series of business transactions and identifying the two or more accounting heads or components involved in each. If a transaction involves cash, we will also classify the cash flow as either an operating, investing, or financing activity. After a couple of transactions, I recommend that you pause the video to try and guess the answers for the transaction that is being discussed. Then you can resume the video and check if you have got it right. Once we have evaluated all the transactions, we will post them in Excel. So let's get started. Anita plans to start a business by investing 30,000 from her savings. Anita is investing equity, so we have equity as the first component and cash is coming into the business. So that is plus cash. Raising money or investing money into the business in the form of equity is a cash flow from financing activity. Next transaction, the business decides to borrow 20,000 more from the bank at 6% interest per annum. Interest will be paid when due. Now, the business is taking a loan from the bank, so loan is the first component. Cash is coming into the business, so it is a plus. Taking a loan is also a part of financing activity, so even this is CFF. Anita wants to construct a shop and the cost for that will be 25,000. This amount will be paid in two installments. 15,000 will be paid today and the balance will be paid soon. Now, all transactions are done by Anita on behalf of the business. So these are business transactions and all these will be recorded in the accounts of the business. The shop is an asset and it is the first component. We have paid 15,000. So that is a minus cash. Buying or constructing an asset is a part of investing activities. So this is CFI. 10,000 will be paid later. This is component 3, that is payables. We will assume that money will be paid within a year. So this is a short-term or current liability. She decides to buy a pickup truck for 5,000. The pickup truck is also an asset. We have paid cash, so minus. Even this is a part of investing activities. She places her first order of fruit and vegetables worth 20,000. 50% of the invoice is paid now and balance will be paid after 30 days. Fruits and vegetables are the inventory and inventory is a short-term or current asset. We are paying some cash, so minus 10,000. Buying inventory is a part of core operations, so this is CFO. Balance will be paid later, so this is payables or creditors. As this liability will be paid after 30 days, it is a short-term or current liability. She had hired a helper and she paid him a monthly salary of 2,000. Paying salary is an expense for the business and expenses are shown in the income statement. For expenses, we also put a minus sign. Cash is moving out, so this is a minus. Paying salary is a part of core business activities and hence this is a CFO. Utility and fuel bill for the month is 1,000. Utility and fuel are also expenses for the business and will be shown in the income statement. This cash outflow is also shown under the operating activities. From her inventory, goods worth 15,000 are sold for 30,000 cash. Now you have to pay attention to this transaction as it is a bit complex. First, let us record the sale. Sale is an income for the business, so it will be shown in the income statement with a plus sign. Cash is coming in. Sales are a part of core business activity, so this inflow is a part of operating activities. Now, goods worth 15,000 are sold for 30,000. So 15,000 is the cost of goods sold or COGS. COGS is an expense and we record it in the income statement. Now we have sold some of our inventory and we need to reduce it from our inventory balance. So this is the fourth component minus inventory in the balance sheet. So this business transaction had 4 accounting components: sales, cash inflow in CFO, COGS, and reduction from the inventory balance. Goods worth 2,500 are sold on credit for 5,000. Payment will be collected after 7 days. I want you guys to try this out first, so pause the video here and try to identify the accounting components. Sales of 5,000 is the first component. There is no cash inflow here as goods are sold on credit. So the second component is receivables or debtors. We have to receive money from someone, so this is an asset and we will hopefully receive it from them within the next 7 days. So this is a current asset or a short-term asset. Now we have to record the cost of goods sold. So the third component is COGS, and this will be shown in the income statement. Last, we have to reduce our inventory balance by 2,500, and this is our fourth component. Anita decides to pay the interest on loan taken on a monthly basis. Now the business has to pay the interest. Interest is an expense, so it is shown in the income statement. We are paying cash, so cash is going out. Paying interest is a part of financing activity of the business. So this will be shown as an outflow in CFF. We will calculate the amount of interest when we post these transactions in Excel. Now, some businesses also show paying interest as a part of operating activity. That is also correct as per the accounting standard setting bodies. An amount of 3,000 from debtors or receivables are collected. Now we are collecting money from our debtors. So money is coming in. Collecting money from customers for the goods sold to them is a part of operating activities. As we had to collect money from someone and they have already paid us, we have to reduce this amount from our collectible balance. So that is component 2, reduce this amount from the receivables. Depreciation on the truck and shop interiors are 500. Depreciation is a non-cash expense. We don't pay depreciation to anyone, but this is a reduction in the value of our asset due to frequent use, wear and tear, etc., and hence it must be recorded. First, we will reduce this amount from the value of our assets shown in the balance sheet as accumulated depreciation. Though non-cash, it is still an expense for the business and it will be shown as depreciation expense in the income statement. Depreciation is the accounting way of showing that the value of an asset has gone down during the year because it was used in the business. It is a charge or a justified reduction of profit. The amount of depreciation to be charged is decided by the management. If they show a higher amount, it will look like the business made less profit. If they show a lower amount, the profit will appear high. However, depreciation only reduces the accounting profit and it does not impact the cash flow. Tax of 20% is paid on the profits. Tax is an expense, so it will be shown in the income statement and we have to pay it. So this is a cash outflow. For simplicity, let us assume that taxes are a part of core business activities and hence it will be shown as outflow in operating activities. We will calculate the taxes once we determine the profits. We will get to know the amount once we post all the transactions in the financial statements.